Index universal life is doomed. While the last decade has bailed index universal life out because we just came through the greatest bull run in history, ultimately the next decade is not going to be so kind to it. Now, I get agents that reach out to me all the time, and while it's super frustrating and it makes my head spin, I'm actually grateful for it because it inspires content like this. Because I get a lot of people that reach out to me and they're like, Chris, you don't understand. Well, I do understand. In fact, you don't understand, Mr. IUL agent. Ultimately, what I'm going to show in this video is why there is not a path forward that I can see that makes me believe with any level of confidence that IUL has a chance of outperforming even the measly old whole life insurance. With all these influencers out there talking about how IUL is the enhanced improved whole life insurance, I'm going to show you in this video why whole life insurance has stood the test of time, will stand the test of time, and ultimately, while every path forward spells doom for index universal life. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's get into this fun. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today we are talking about my favorite topic, which is index universal life versus whole life insurance. And I know the title and everything. I'm going to show you that the next decade is basically going to be impending doom for index universal life. Now, I know that may sound like hyperbole, it may sound like hype in general, but I promise you, when I get done this video, you're going to see what I have to see, or you're going to see what I have to show. And I think the math and the facts, and when you understand all the moving parts inside of how index universal life works, you're going to see why whole life insurance is what I lean on, and why I focus on whole life insurance to be a foundational asset, because it stands the test of time. It has the proven track record, whereas index universal life has been a failing financial experiment that's hitting the end of its rope, much like traditional universal life went through its process, and it burned out and phased out as well. And so here's the deal. I want to get into this, and I think where we need to start is understanding and thinking about, like, all right, what are the variables that go into an index universal life policy being successful? Now, there are a lot of different things to consider, but what I want to do is I want to go to my board and I want to be able to explain a couple things, and because in the way that I do, I like to educate. And so let's get into it. Let's just get over here and we'll talk about the principles about indexed universal life insurance. And so, with IUL, there's a couple things that you need to consider. First off, there's moving levers inside of the policy that you need to take into consideration, right? And these moving levers, I've got a lot of other videos. I'm not going to spend a lot of time in this video talking about this, because if that's something you need education on, go watch my IUL training playlist, and I've got a ton of videos in there that will teach you about it. But the moving levers are things like cap rates, par rates. Participation rates is what par rates stands for. Spread charges, I'll just write spreads. No risk rate, NRR. They have these and other things. Cost of insurance variables, all these things. These are all variables, right? That you can't control typically, or if you can control some of them, you can never control all of them in an IUL. They move these things around for the fees and structures. In different policies, all carriers do them a little different. Some carriers have different moving levers based on different index selection and allocation options inside of the same fund. They are not simple. It's not simple to understand for most people. This is something you need to understand going into it. But more importantly than these moving levers is understanding that really all IUL is a traditional UL with an options strategy. And this, I promise you, when you understand this, you're going to understand why IUL is doomed moving forward. IUL is a traditional UL with an option strategy. That means you have an annual renewable term foundation base, that is the insurance part, and then you have cash value that goes on top of that, and then you can structure it with option B or option A, whatever. But what happens is you put your money into the insurance company. This is the flow of capital. You put your money into the insurance company, you pay your premium. A portion of that premium goes towards insurance cost and fees, right? And a portion of that will go towards cash value. That's just the way it goes. It gets broken down, and the insurance costs and fees is where the annual renewable term kind of comes into play, plus other fees, admin charges, stuff of that nature. So you put your premium in, it goes in, and the money that goes into the cash value then gets what's called an options budget associated with it. So out of this cash value, they'll say, hey, we know that we can get a return, let's call it 4%. And I'm gonna do that intentionally. It's a little higher than that right now, but I'm gonna explain it and show why I'm saying 4% right now. So let's say 4% is the options budget. So then what happens is they say, all right, we got a 4% options budget. Let's just say out of all the premium they had, $10,000 went into the cash value portion after all the costs of insurance and fees. 4% off of 10,000 is 400. So this is their options budget. They take this 400 and they go and buy call options. Okay? So this is something to understand. This is the flow of IUL. Now I've had some agents tell me, okay, Chris, in an increasing interest rate environment where we are right now, interest rates going up means that the options budget will go up, because what happens is this cash value, this $10,000 goes into the general fund, the GF, general fund or general account of the life insurance company. This is where they dictate this 4%. Now, 6-7 months ago, this 4% was actually extremely accurate. So what's happened is this 4% has gone up to 4.5 to 5%, okay? And so when we look at a 4.5 to 5% situation, now what goes to show here, instead of having $400 for an options budget, we have $500. And so in effect, that would get you to believe that you have more money to buy call options, which is how they set the price of all of these different fees up here. All of these fees and moving levers and all the pricing of the product is always set by a combination of the options budget and the cost of these options. Now, here's the thing that we haven't talked about. The cost of options is variable. It fluctuates. Options are a supply-demand product, okay? So the argument that I've been getting is as interest rates go up, so as inflation goes up, as the federal funds rate, we'll just say, just to keep it simple, funds rate increases, the theory is, so there too will the general fund performance, so there too will the options budget. Options budget follows. Okay? So what's happened is, there's a video I did with Bobby Samuelson a while ago talking about the fact that cap rates are still going to continue to go down or remain flat. And we made this statement, this bold call, if you will, that rates would go down or stay flat. And a lot of people were fighting with us. And basically now there's been a couple carriers that have increased cap rates. And so they said, see, we told you, you were wrong. Cap rates are going up because of this. Well, here's the deal. This is really what's happening. There's a lag, and cap rates have gone up for a couple companies in a couple situations, especially, but they're all younger companies with newer products that are doing this. And I know people are mentioning Nationwide just as an example, right? Nationwide is doing this, but Nationwide's a baby company in the IUL space. They're not 10 years old, right? Like, so most of their money is newer, cheaper money, so they're able there's a lot that goes into it, right? And so the bottom line is, yes, rates can go up, but why are they going up? Here's the deal. You have 4.5 to 5% right here. Let's just say rates went from mess that up. Let's just say, I just got ahead of myself here. Let's just say rates go from 4% and they go to 5%, like we showed in the example. Now, if options costs stay the same, if all things are equal, well then yeah, caps have a chance to go up. If options costs remain level, caps can increase. If options are level. So if options increase, what it does is as options increase, right, I'll just do this and make a little graph out of it. As options increase, if they increase at the rate of the rate of appreciation. So let's just say you can see here, 4% going to 5%, that's a 25% bump, right? Because 1% increase out of 4, 1 into 4 is 25% of 4, right? So that's how that works. And so what happens here is if options go up by 25%, it's basically a net neg, like a net neutral, right? So if they increase by 25%, but here's the deal, if they increase by more than 25%, it's a net neg, right? And so that would mean even though the general fund is going up, the cap rates would go down. We've been living in a really unique environment. Just look around. If you go into the economy right now, if you go look at the S&P 500, you look at the Dow Jones, you look at any of the major indices, you look at the economy we live in, gas prices are going up, you go to Costco, the bill that I used to spend $250 a week at Costco is now $400 something. We're experiencing, and real inflation is outpacing the numbers that the CPI and the Bureau of Labor Statistics is telling us, right? Like that is what it is. We need to understand that all of the numbers that we're being told, you're feeling it much differently if you're like most Americans, right? Gas prices, I live in Arizona, gas prices are like $5.20 a gallon right now. It's crazy town. And so what's happening is we're living in this little blip in time where nothing makes sense. And so it's given an opportunity for the cap rates to go up because the general fund has gone up, but the options costs have stayed level because nobody's caught on to the fact that, there's this false sense of security in the economy. Everybody thinks things are okay. As this catches on, it will go the other direction. Because here's the deal. This is what's important to understand. As we move forward here, I'm going to just erase this so I have a little more room. As we move forward here, let's talk about the last decade because I want to work backwards and then go forward. The last decade, I have the IUL challenge that says, show me an IUL that has outperformed illustrations during the greatest bull run of all time. If this product gives upside potential and downside protection, show me during the greatest bull run where it gives you the upside potential. Show me policies that captured the upside potential. It doesn't happen. Maybe 5% of the time you can have it happen. Well, what about the other 95%? You have a policy that will blow up in your face and it'll be the biggest financial regret in your life is putting your money in an IUL, right? So the opportunity for upside potential in the greatest decade of all time wasn't actualized, wasn't captured by 95% of policyholders out there. I actually just had an amazing conversation with a guy who wrote a book called Lapsed, which is fantastic. I've got my book called IUL Exposed coming out that breaks all this down because my passion is not just to save you guys, like the policyholders and the people that are looking to put their money into it. My passion is to save the agents from hurting all their relationships and friends and family because the ripple effect, I think, in what I can do for an impact with a book on IUL is much more impactful. And so I've got a book coming out called IUL Exposed that I will be sharing as it becomes available. That's going to be coming up. Now, right now, that is the last decade. Now, here's the deal. If it didn't perform the greatest decade ever, what's it going to look like moving forward? Well, let's take a look. I'm not going to sit here and tell you I think I know where the world is going because if I could say one thing, is that I've had a really poor ability to predict what the government is and is not able to do as far as kicking the can down the road and dealing with things and manipulating the economy, right? Like I think we say, 2007 through 2009, beginning of 2009, things were really bad. I think everybody would agree that was a bad time, the Great Recession, whatever. As things started to recover from mid 2009 through 2012, if you recall, things recovered, but it wasn't really a good recovery. There was quantitative easing 1, QE2, QE3, and it's basically QE to infinity. We're at $33 trillion of debt as a nation, $200 trillion of unfunded liabilities, right? We have all this stuff going on. And so logic goes to show, like, we can't just keep printing money. We can't just keep running debt and deficits. We can't just keep giving stuff away to people that don't really produce more than they're consuming in this country. Eventually, this has got to come to an end. The challenge is now we also have, which the last decade we haven't had, is we have inflation. And the only way to control inflation is to increase the interest rate environment, right? Is to increase rates, which is great for savers and bad for investors, because when you increase rates, what it does when inflation goes up, we have to increase interest rates, and that sucks money out of the economy. Money comes out of the economy, and that decreases asset prices. That is the definition of how it works, right? Effectively. And so what we have here is, like, we have a conundrum because we have all this debt. And listen, in a bubble, I think we have a responsibility as a government. That's not what this video is about, but we have a responsibility to get this stuff under control. I think we've dealt with a bubble built out of irresponsibility, I guess is the best word to use. Irresponsible spending, not wanting to deal with our problems and actually dealing with them in 2007 through 9, just thinking we can print money and deal with it and get away with it. And then we dealt with a decade of that, and people have fallen into this false sense of security. It's, made our debt and our unfunded liabilities go through the roof. And so now what do? We have to look at this and we say, all right, there's a couple options that we have moving forward here. And so what I want to do for you now is lay out a path of what the next 10 years looks like, potentially. I'm going to go 3 options. And maybe you have other options. If you do have other options, leave them in the comment section. I would love to engage with you, and I'll do a video taking that option into consideration. But these are the 3 options that I have figured out, that I have contemplated, that I believe are a possibility over the next decade. First and foremost, interest rates go up. Interest rates increase. Okay, so let's talk about interest rates increasing. What are the viable possibilities of interest rates increasing from a realistic perspective? I want to talk about this for a second, because if you think about interest rates going up, when we talk about the possibility of interest rates going up, we look at, well, inflation is going up. So what do we have to do? If inflation goes up, the only way to control inflation is to increase interest rates, suck money out of the economy, force rates back down, get the government in control, and make it all happen, and things will be good to go. And if you do this, now you're talking about a situation where when you increase interest rates, it puts a lot of pressure on the economy, right? And that pressure on the economy will pull value of companies out. It'll pull value of real estates out. It'll drive up the cost of borrowing, and that has a pain that will be associated with it in the economy, and there's no getting around that. And what will happen from there is all investments like the S&P 500 and every other index that IULs are using will suffer. They will struggle. There's no way around this, right? And so as interest rates go up, sure, it will increase your options budget, right? So if we look at this, sure, the options budget created by the general fund of the life insurance company will increase. Okay, that's fair. It will increase. But does it matter if the options budget goes up if all this volatility leads to an equal amount of options cost increasing. Furthermore, here's the deal. Let's say that it doesn't. And first of all, I don't think there's a world that happens where options costs don't increase drastically. It always does. That's an economic principle that has happened always through history of the market movements in these boom-bust cycles. At the end of a boom cycle, when we enter a bust cycle, options costs go through the roof. That is just the way it works. And so when we look at this, we say, all right, we have the options budget's going to increase, the options cost is going to increase. That negates the benefit of the increased interest rate environment for the options budget increasing, is the cost of options increasing. That basically creates a neutral environment, if not a negative environment, which would basically drop the interest rates altogether, right? So when we look at this, like, that's one thing. But here's the other thing that we're not thinking about. What does it do? It drops the performance of the underlying assets, like equities, like mutual funds, like company valuations. And what does that do? That makes it so the S&P 500, for instance, goes kaput and has 0 years and negative years for long periods of time. It'll be flat. You know, we can have these periods of time where there's too much economic pressure, people don't have any money to spend, people aren't traveling, people are struggling in all these ways. And so the next decade is not going to be good. I'm not saying it's going to be zero, but I'm saying it's not going to be good. To think, like, if you go back to the Great Depression, like, there was, from 1929, when the Great Depression happened, it was not till the early 1940s that market recovered. I do see a scenario potentially where we have a lost decade, right? Where the market doesn't recover. Now, do I think that's going to happen? I don't know, right? I'm not a doomsdayer. I'm not a guy that's saying that that's going to happen. But here's what I do know. The first option that is a possibility is the fact that interest rates could keep increasing. And I think there's a lot of people out there that say, well, yeah, I think they have to increase. I think the likelihood of them increasing is what it is. And when you look at what those increases will do to the economy and how that impacts all the moving parts inside of an IUL, both the market performance, the options budget, and the options cost, and how those three things correlate with each other, it is not a good scenario one way or the other. All right, so that's option one. If you have, give me a 1 in the comment section if that makes sense. Give this video a like if you're finding value. If you think there's an IUL agent out there that needs to see this, please share it with them, okay? So now we're going into number 2. Number 2 is interest rates go down. Interest rates decrease. Wow, that's a touchy one, right? Because a lot of people are going to say, man, Chris, interest rates go down? Really? Like, have you looked around? Like, you just talked about it, man. There's like, what do we got? We got $33 trillion in debt. We got $200 trillion in unfunded liabilities. Inflation's going crazy. If we drop in interest rates, inflation is going to go through the roof. Listen, they've been talking for a long time about potential negative interest rates, right? Like, at the end of the day, we don't know. They may come up with ways to manipulate the economy that we've never heard of. Listen, back in 2009, nobody had ever thought about quantitative easing and just money printing out of thin air the way that they were doing and just injecting that money into the economy the way that they did. Nobody had ever heard about that. So if you think that they are beyond doing something unique to kick this can down the road, well, I got more news for you, because the government's ability to manipulate the economy is the most underrated thing that this world has ever known. And so, yes, I don't think this would be good. I want to be completely, fully transparent about this. This would be the bad scenario, because I'm not just talking now about IUL. I'm just talking in general. This is a bad scenario for anybody in our economy. It's bad for our country. It's bad for the world. It's bad for our future. If this happens, if this scenario happens, this is bad for our future. This is bad for my kids. It's bad for my grandkids, and people will be paying for it for years to come. And it could be the downfall of a lot of things in the long run. So this is really bad. But it's not just bad for all those reasons. It's bad for IUL. Why is it bad for IUL? Because if interest rates go down, well then then the general fund performance goes down, which means the options budget goes down. But here's the other thing. In a decreasing rate environment, it's going to create a lot of uncertainty, right? Now, I'm not saying the economy is going to crash, because typically interest rates, when they go down, the S&P and asset prices could go up. I'm going to write possibly, right? Because there is an environment where we could have a stagflation situation, right? Where interest rates go down, but inflation is going up. And if we don't get inflation, that's the variable in here that we've never dealt with, right? We've never had to decrease interest rate environments, decrease interest rates in an inflationary scenario, right? So we're really dealing with this for the first time in Keynesian economic history in our fiat currency system since the institution of the Federal Reserve in 1913. This is the first time we've ever had to deal with this, right? So in this scenario, we have to take inflation into account for another variable, which could make asset prices go down still, right? Or even if they don't go down, the actual purchasing power of them would go down, and that would just be a really negative scenario, right? And so then the other element to think about when interest rates go down is the fact that, all right, we have interest rates going down, all this stuff, it creates uncertainty, because if we have a world where inflation is high and the world is uncertain and it's got the potential of the market going down, even if it doesn't go down, at the end of the day, if people are confused, the market is moved by certainty. And anytime there's uncertainty, what happens is option prices go up. That's just what options are. Options, people are basically speculating and hedging and playing the other side of the coin as a risk factor. And the more people feel like they need to do that because of the uncertainty the more there is in the market, the more the cost goes up, because it's a supply-demand product. And so once again, this is actually the worst case scenario for IUL. As bad as the first one is, this is the worst case scenario because of the fact that now we have the general fund going down, we have the options budget decreasing, we potentially, I'm not saying this will happen, but we have the potential due to uncertainty for options prices to go up. So with a reducing options budget and an increasing options cost, then cap rates and all other fees get crushed. I mean, they would get crushed. It would be catastrophic, right? Now, asset prices, who knows? I think if there's a lot of uncertainty, I think there's a chance that you're losing real purchasing power based on how inflation plays into the game for the long term. Now, I want to take a second now and kind of zoom out and look at this and say, all right, we've looked at these two things. We've looked at the environment where interest rates go up, and we've looked at them when interest rates go down, okay? So if we're talking about up, how does this impact whole life? I showed how it impacts IUL here because of the fact that it creates all this uncertainty. The market will get crushed and it'll be what it'll be. Well, for whole life, when interest rates go up, that means the general fund goes up. And with IUL, when you're a profit center for the company, with whole life, you are a partner of the company. And when the general fund goes up, the dividend increases. I did an interview with Harry Dent. It was awesome. He talked about it in the interview that during the hardest economic times, whole life insurance has always been the best performing asset. We are coming into what I believe is going to be a really hard period of time. We've got to take our medicine, economically speaking, right? And I think right now is the best time to get a whole life insurance policy for these reasons. And it blows my mind that I have agents reaching out to me, like the guy that was reaching out to me today, and trying to convince me about how IUL is so good. And they also then try to convince me how bad the economy is going to get, and they don't see it, and they're trying to tell me that I don't see it, and they can't even articulate and understand all the moving parts because they're just focusing on this one little thing, which is the interest rate increase. That's all they focus on. They don't see all the other moving parts, right? And it's so frustrating to me. And I just want to help these people. And I know I come off as sounding a little angry because it's so frustrating, but it's frustrating because I'm trying to help them and they don't want to open their mind to being helped, right? And that's challenging for me. Now, when interest rates are going up, it is the best thing for whole life because those policies will outperform. And the cool part right now is imagine if you get a whole life policy that's giving you a dividend, say of 5.2% right now, the current dividend is 5.2. If interest rates continue to go up, let's say interest rates can hit 8%, and dividend rates will trail and they'll eventually hit 8%. If that happens, every whole life policy that you see today and what it's performing, the current assumptions in a whole life policy are all based on, because all the costs and everything are fixed and guaranteed in a whole life policy. The only variable when you look at a current illustration side of the equation is, are they going to pay a dividend? And if they are going to pay a dividend, it's assuming they pay a dividend every year at the current dividend rate. So as dividends go up, there's a chance whole life policies in this increasing environment will outperform what you look at. Whereas you look at an IUL, and I could pretty much guarantee a 95% chance it won't even match what you're looking at, right? And especially moving forward in this economic environment, it's just disgusting. And so now let's look at what happens if dividend rates go down, or if interest rates, dividend and interest rates, because they correlate. Dividend rates meaning also the options budget, right? Because that's the general fund performance. And interest rates go down. If they go down, well, yeah, it's going to be more stress, right? We just had the Section 7702 update. They reduced guarantees on whole life from 4% to 2%. They did that to give flexibility in the general fund because the decade of low interest rate environments and quantitative easing and all that created a lot of pressure on general funds, and it put us into this position that we're in today. And at the end of the day, they reduced anywhere from 2 to 3 3/4, 3.75. It reduced dividends to and the guarantees, I should say, in whole life to be anywhere from between 2 and 3 3/4. That is to release pressure and to allow companies to have more flexibility in the way they design their policies and the way they price their policies out. And I think that is a really good thing. I know a lot of people say Section 7702 is a benefit for IUL. It was a much greater benefit for whole life than it was for IUL. That's just a fact. Now, in a decreasing interest rate environment, it's tough for both of them. I already showed how it's tough for IUL, but for whole life, we're at these rates at 5.2% right now for one of the companies we work with. That's the lowest they've had in nearly 8 decades. Right? So when we look at 8 decades, dividend rates, we're kind of getting bailed out right now by interest rates going up. And so I think that puts upward pressure, which is a good thing, and support for dividend rates. But as that goes down, that may be negated. We don't know what the government's going to do right now. I think it's all dependent on the economy. And we'll see what Powell does and what his options are when the economy starts to crash. Right? As options prices start going up, when the market starts to crash, how's he going to handle rates? It's easy to keep being bold and raising rates and being hawkish on rates and raising rates like that when the economy's doing well, when the stock market continues to go well. But when it starts to come down, when we hit that tipping point, how are they going to react? And that's where I don't know the answer. I'm not going to sit here and try to tell you I do know. I think anybody that tells you they know is foolish or ignorant or like egotistical. But I know it's a possibility that they'll go down. I know it's a possibility that they'll do the right thing and keep them going up, but I have no idea. But what I do know is we're the lowest in 8 decades, and to see whole life insurance dividends at the lowest they've been in this long, I don't see them going much lower. So the floor on a whole life policy is much higher than a floor on an IUL with both of these two scenarios. And meanwhile, the upside I would put the argument of the upside on a whole life policy based on these variables that I'm talking about is actually higher than the quote unquote upside provided in an index universal life. Okay, so yeah, that's something to understand. Now the other option, right? The other option, because let's say we said rates go up, rates go down. Option 3 is rates remain level. Okay. So if rates remain level, what does that look like? Well, I'm not going to tell you once again what to think, but the way I look at it is if rates remain level, well then we have to see how the economy plays out. I think as rates remain level, we have once again the debt issue, unfunded liabilities, ULs, right? Actually, I should probably just unfunded liabilities because ULs is universal life. Ability, right? Unfunded liabilities with the debt. We have these things going on, and so that's going to put pressure. Not only that is with our interest rates remaining level right now at, let's call it 7% with a level rate. The thing is with this debt, the disgusting part about this is this has to convert. A lot of it is going to be converting every year to newer, higher debt. Like a lot of the 33 trillion that we have in debt right now, we have it at like 2%. And if we have to convert a portion of that to 7% every year, the cost to service it is going to absolutely destroy our balance sheet and put us into a perpetual spiral downwards, right? That is another reason why there's a lot of people saying, hey, we can't keep raising rate because one way or the other, this debt is going to rear its ugly head on us. The only way that we can get rid of the debt is to inflate the debt away. And that is the argument for why rates will come back down. So anybody that thinks they have this all figured out is delusional. What I'm a big believer in, that we do need to have some money in fiat currency. We need to deal with this. And life insurance companies are the best companies in the world at managing risk. And so what I want to do is I want to put my money there because the most successful companies, banks, and politicians and entrepreneurs have been utilizing life insurance, whole life insurance policies for 180 years to manage that risk. Whole life insurance companies have gone through 3 different versions of currency in the United States since 1842. I did a video on this the other day. I'll put it up in the corner here and I'll put it on the end screen so you don't have to click away right now. But like they've been doing this since 1842, all the while IUL has basically stolen the credibility that whole life has built and created in 1997, really gained traction in 2009, really has never performed and met its promises. It's a failing financial experiment that's dragging everybody down with it, and they're selling it as a solution to a problem. But at the end of the day, you're a profit center for the insurance company. With whole life, you're a partner. And so I want to partner with a company that's been doing this as successfully as possible for as long as possible. I believe that no matter what, whole life insurance companies can invest in real estate. They can invest in gold. They can do gold. They can do other options, alternative investments. I'll just call alts. They can do all this inside of the general fund with a small percentage of the portfolio, and this can create asymmetric risk or asymmetric returns that you are directly participating in to get this return, right? To create this foundation. You don't want to be taking risk in the policy. You want to outsource your risk in the policy and let the insurance company manage that risk for you with the safe money that you need liquidity, use, and control of. That is it. So when you look at this in a flat rate environment, whole life is going to continually perform better because dividend rates will come up because they haven't come up yet. So dividend rates will come up, but I think because of the debt, because of the stress that that's going to have, it's going to put stress on markets, right? Markets will have stress. That means they will perform less. They will have uncertainty and division. That will make options costs go up. So if we have markets go down, options costs go up, even if the options budget remains kind of elevated and whatever right now, it's still not a good scenario for IUL. So you can see no matter what happens with any of these 3 scenarios, there's not a scenario that IUL does well. And I can name a couple scenarios where scenario 1 is a perfect scenario for whole life with interest rates going up. because they're participating, they're going to capture it, and dividend rates will follow. If interest rates go down, it will be stressed, but at least as interest rates go down, bank account rates, which people are freaking out about right now, being excited and freaking out in a good way, being like, I get 5% return in my savings account at Chase Bank, right? They're excited about this 5%. Well, guess what? As this 5% gets eliminated and goes back down to 0.1% like we were a couple years ago, when interest rates go down, whole life is still going to be paying 4.5% to 5%. That's pretty solid. All the while, like I showed over here, IUL will be struggling. Once again, it's not good or bad ever. It's like, what problem are you trying to solve, right? And as rates remain level, I just showed you, it's not good for IUL. It can be good for whole life. And once again, as a foundational asset, that is it. Just understand what problem you're trying to solve, what tool you need to use for the job. Make sure you're doing it the right way. And I think when you do that, and you get everything in alignment, and you align your money with your values and beliefs and what's moving forward here, that's when you're going to have true success. And the problem that I have is all these IUL agents that believe all this stuff and believe all these potentialities, but they haven't thought through the entire process, thought through all the variables, maybe because they don't understand all of the different variables that come into the equation. Hopefully, as I've gone through this video, it's made sense to you. If you have any questions, comment in the comment section below. Reach out. I have a whole program. If you have an IUL and you're looking at this and you're now scared to death, don't be scared. Go down. I have a link down there called Rescue My IUL. You can go to rescuemyiul.com. You can check it out. If you are a life insurance agent and you are looking to build your business and you are looking at this and this makes sense for you and you love the passion, you love what's going on, you want to help save people, I just launched my new planner to help life insurance agents run their business, connect with more people, learn how to make more impact, and lead with value. We're launching the Life 180 Challenge. You can go to planner.life180.com. Check that out. And that's it. I'm so excited about this. There's never been a better time to be in this business because there's never been an opportunity to make such an amazing impact in people's lives. I'm just excited to be here. I love what I do, as you could probably tell. And that's it. Hopefully you found value in this. If you did, please like this video, share this video, subscribe to the channel, hit the bell, all that fun stuff. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.